it from here. Thanks for waiting.
No problem. So, all right. So what we're going to talk about for the remainder of the period, like Alan said, is the casualty loss deductions. It's governed by Section 165 of the code. There are two main areas that we want to look at. One is if we're talking about a loss that was incurred in a trade or business. And one is if we are talking about a loss that we're going to call personal use property. So personal use property would be if you have your residence and your residence suffered damage as a result of the hurricane, that's personal use property. If it's a secondary residence that you own and you use it to rent out to, as an Airbnb or for other renters, that's going to be incurred in a trade or business. We would fall into that category. Now, under both categories, the basic rule is that you look at the fair market value of the property immediately before the casualty event, immediately before the hurricane. And then you look at the fair market value of the property immediately after the hurricane. So whatever that reduction is, you can claim that as the casualty loss, but in a lot of situations, you're limited to the amount of your basis in the property. So that if the reduction in the value of the property is $100,000, but your basis in the property is $60,000, in most situations, you're going to be limited to the $60,000 deduction. And similar to what we had talked about before, if you have a $100,000 loss and you receive $40,000 worth of insurance to compensate you for that, you're only able to claim a $60,000 loss. So whatever loss you are able to claim is going to be reduced by any insurance that you receive after the loss occurs. All right, so then if I can scroll down, hold on one second. There we go. All right, so one other item to talk about is related to the trade or business, and this is an exception for trade or business. So if I have a trade and business and I have an asset, and let's say that the fair market value of the asset is $100,000 and it's destroyed, meaning that I could have $100,000 of a loss because that's the value of the decrease. If the actual basis of that asset was larger, meaning let's say I had a basis of $120,000, if it's a trade or business and I have that casualty loss, I'm able to take a deduction for the entire $120,000. It's not limited to just the decrease in the value of the property. Now, if this was personal use property, I would be limited to just taking the $100,000 because I have to take the lesser for the personal use property of the decrease in value or the basis. But again, if you're talking about trade or business property, if prior to the casualty, the basis was higher than the fair market value and the property is destroyed, then you are actually able to take the deduction equal to the basis, not just the decrease in the fair market value. One other item to note for trade and business property is that you have to calculate the loss for each item individually. You cannot aggregate any items. Every separate item that is part of your trade or business has to be calculated individually to determine what the total loss is. All right, so we've got kind of just a quick little slide here recapping, and again, this is just for trade or business. So if I have damaged property, the deduction is equal to the lesser of the fair market value immediately before the event, reduced by the fair market value immediately after the event, or the adjusted basis, whatever the lesser of those two is. And if it's destroyed, I get either the greater of what my basis in the property was. If it's destroyed, I can get more than just the fair market value reduction if my basis is more, which is what you see there. All right, so now we've got, again, just one more slide, general rules for personal property versus trade and business. We talked about the trade and business rules on the left-hand side. This chart, what we've got here, talks about some of the additional rules that apply to personal use property. One item to note is that as a general rule, you're not able to take a casualty deduction if you have anything in excess of your casualty gains, but that's not applicable to a federally declared disaster. So we don't have to worry about the first box for the personal use property because of the hurricane. When we're looking at personal use property, you are able to combine the land, the dwelling, and say the shrubs that are associated with the property. Now, if you were using that for a business, you would have to have 3 different calculations: one for one for the building, one for the land, one for the shrubs. In this situation, you're able to just combine them together, and it can have a better tax result for the taxpayer depending on what the basis is in the property and what the actual losses are, as we can see later. A couple of other items is that typically you're limited to a 10% AGI. Typically, you're limited to only claiming items that are $100 or more. In past, Congress has waived these requirements whenever we've had, and in most times where you've got a situation such as a hurricane. And in addition, in a normal situation, the items that you're taking as a casualty are claimed as an itemized deduction, meaning if you take the standard deduction, you could not claim these. But again, in most situations in the past where we've had a hurricane disaster relief like this, Congress has waived that requirement. So a taxpayer could take the standard deduction and still have an itemized deduction in addition to that for the casualty loss. All right. And then I'm going the wrong way, sorry about that. All right, so these were the additional rules for personal use property, which we just talked about, which were on the slide as well. We've got an example here, which if you look at the IRS publication 584, kind of walks you through the calculation of how you're supposed to determine the casualty loss deduction for personal use property. So if we just look at this line here for the chair, it has a cost basis of $350. The client received $200 worth of insurance for the property. At the time before the casualty event, the fair market value was $275. The fair market value afterwards is $0. So the maximum that the client could receive would be $275 because that's the difference between the fair market value immediately before and immediately after. Looking at that, we have the $275 again as the value. But in this situation, because the client received $200 worth of insurance, that reduces the $275 to $75. So the only thing that can be claimed would be the $75. Going down the further line, the clock is the same idea. It's a $90 cost basis. It's a $60 value. It's worth nothing after the event. But in this situation, because the client did not receive any insurance, the client would get the full $60 deduction for the clock. And again, because we're in a hurricane, you can have this deduction even though it's under $100 in most situations, assuming that Congress does what they've done in the past. All right, so what I'd like to do then is we have 3 different examples here. I think that they're pretty self-explanatory. They're from the actual regulations. What makes me laugh is that you can see how old these regulations are because it talks about in 1956, he purchases a car for $3,600, which is just, it's interesting. So, but just walking through this fact pattern very quickly, if we go to the actual deduction for it, we've got a car that was worth $3,600 when it was purchased, so that's the basis. At the time of the accident, the actual casualty, it was worth $2,000. After the casualty, it's only worth $1,500. So we have $500 worth of property being destroyed. Now in this situation, because the client received $300 worth of insurance, they're only allowed to take a $200 deduction as far as the loss goes. Now, in this example, what we have is we have the client purchasing land, which is an office building for the lump sum of $90,000. So again, it must have been nice in 1958. $18,000 of that is allocated to the land. $72,000 is allocated to the building. Now, again, because we're talking about this being a business property, they have ornamental shrubs, but we have to include that as a different category. We're not able to lump that in with the land in the building like we would do with a personal use property. So at the time that the event happened, the adjusted basis in the building was $66,000. The adjusted basis in the trees was $1,200. So that's going to be some of our caps that we might have to look at. What happened as a result of the casualty is that the value of the building decreased from $70,000 to $52,000. And the value of the trees decreased from $2,000 to $400. $500 or $5,000 was received to recover the loss on the building. Nothing was received to cover the loss on the trees. So walking through the calculation, what we have here is that we have the value of $70,000 prior to the casualty event. It's only worth $52,000 after the casualty, so we have an $18,000 possible casual loss. What we have to do first, in addition, is we reduce that by $5,000 because that was the insurance that was received. So we have our $13,000. It's less than the basis, so we're okay there. So the casualty loss with respect to the property, to the building, is $13,000. Turning to the trees, they had a value immediately after the casualty of $400, immediately before of $2,000. So we had a destruction of the casualty loss here for $1,600. But in this situation, our basis was only $1,200. So the casualty loss is limited by the basis to being just $1,200. All right. And then the example 3 is the same exact facts, except we're using it as a private residence instead of a building that is a trade or business. So it's a personal use property, which again means that we can aggregate all the values together for both the land and the ornamental in the building and the ornamental property, the shrubberies, et cetera. So again, we have a situation here where the value before was $90,000. The value immediately after the casualty is $70,400. So we have a $19,600 possible loss. In this situation, because the basis of the property was $91,200, we're not limited by any basis like we were in the shrubbery example for the trade or business. And again, that's because of the fact that we can combine the properties together because it's personal use property. The only reduction we have to take into account is the $5,000 for the insurance received. And that means that the client in this situation would receive a $14,600 deduction. Again, as Carl had mentioned, this is the IRS link, which has a great website with frequently asked questions, which also are reproduced on the rest of the slides. We think those are self-explanatory. And I think other than that, I think that's pretty much it from our side.